Hey guys, so a really urgent update to share about the changes in interest rates and what that means for households across the UK on a day-to-day basis. Okay, so I'm just going to be sharing from my notes here. I've just written a few things to share with you guys today on what's happened today and what it means practically, and what I think you guys should be doing when it comes to your mortgages, when it comes to savings, and when it comes to your investing. Okay, so first, a quick update. Interest rates sit at the moment at 1.25%. And this is the fifth rise in 6 months. I've just gone to read the Monetary Policy Committee, the Bank of England's, the MPC minutes of meetings, just gone to read that and written some notes here. And the people that voted, the 9 of them in total, 6 of them voted in favour of a 1.25% rate. So 0.25% on top of the previous 1%. And another 3 people wanted that to increase to 1.5%. Understandably, because what a lot of people haven't focused a lot on with this announcement is that the Bank of England also said that inflation is now expected to exceed 11% in October. 11% in October. Yet, the increase in interest rates is only by 0.25%. Now, I understand the challenges. You have a very fragile economy. We've got households with struggling costs of living, and people are struggling in this time. There's so many reasons why they might want to be quite slow in increasing that, because they don't want the housing market to fall apart, or they don't want the economy to crash, essentially, to go into a recession in an aggressive way, and for people to lose their jobs and so on. So it's a bit of a difficult one, because we're all feeling the pinch. The interest rates are going up, so mortgages are going up in cost. But at the same time, inflation is still going up, because the interest rates are supposed to be doing what they're doing and bringing down inflation. All that aside, other things that were flagged up when I read the minutes of the meetings were, the sterling continues to decline against the US dollar, and even compared to the Eurozone more generally. Markets are forecasting that interest rates will carry on to peak at around 3.3% in 2023. Okay, so that's worth mentioning. And I should also mention that the inflation rate of 11% is only CPI. So the RPI inflation is even higher than that, Okay, just keeping that way. Okay, now, so keeping that, looking at those rates, here are some thoughts on various things. Let's talk about mortgages first of all. So around 850,000 people in the UK are on tracker mortgages, and around 1.1 million people are on standard variable rates. Okay, this means obviously that people are going to be feeling a lot of pain, and I'm going to be making some suggestions for you to consider if you are in those scenarios right now. Okay, what this means for people who are in those variable rate situations, or the SVR, is if you look at, say, a typical £300,000 mortgage on a 25-year repayment basis, that would mean that your monthly repayments would go up by at least £40 per month. So that's actually a real number, that's suddenly shown up for you to think about on a monthly basis. Around 75% of mortgage holders in the UK are on fixed rate deals. So if you're on a fixed rate deal right now, you're not going to see any change to your life more generally from a cost perspective. However, those fixed rate deals will of course come to an end at some point. And many of you watching right now will be having your fixed rate deals perhaps end in the next 6 months or in the next year. So there's definitely a consideration to be had. Now, interestingly, I went and did some research before I got onto this recording, and looked at mortgage rates to see how they might have changed, or whether these rate changes had already been priced in. And interestingly, when I looked at a 2-year fixed rate, so 2 years fixed, they were between 2.49% and 2.64%. Okay, 2 years. 5 years fixed, however, was between 2.59% and around 2.75%. So not far off each other at all. 10-year fixed, still at this moment, sits between 2.78% and 3.24%. Now, the way this looks to me, it would appear that banks, essentially, the reason why 2 years and 5 year fixed rates are pretty close to each other is because banks, essentially, in their minds, are thinking that these rates will carry on going up, but then they will decline at some point. Hence why a lot of banks at the moment are offering some really good deals when it comes to 5 year fixed rates. Okay? Now, If you are someone who's watching this right now and you could do with a bit of certainty when it comes to your mortgage, I know I would, if I was in your shoes, I'd want certainty in predicting what my costs would be on a monthly basis. So if I was in your shoes right now, I'd be looking to fix ASAP. So if you are on a variable rate right now, then my suggestion would be, what are you waiting for? Fix now, or fix yesterday already. Get a fixed rate mortgage already. If you are on a fixed rate mortgage and you've got less than 6 months left over for that deal to expire, then I would suggest going ahead and remortgaging right now and locking in a rate as soon as possible. Okay, if you are on a fixed rate deal that has more than 6 months left on that deal, then one thing you might want to consider very strongly is perhaps overpaying on your mortgage. So that way you're cutting into much more aggressively into the capital element of your mortgage, such that compounding bites less aggressively, and by the time that fixed rate deal comes to an end, you're not feeling the pain as much. Okay, so that's definitely something worth thinking about. We made a video recently, which I'll link to above, just kind of demonstrating to you the impact of small monthly overpayments can have on your interest outlook. I should also mention, more generally speaking to mortgages here, there's an obvious point to make, but it's actually worth, talking about here. Obviously budgeting, but also consider, this is in the worst case scenario, you've done everything possible. You've worked on your lifestyle a bit better. You've tried to minimize your costs as much as possible. Another option might be to try to extend the term on your mortgage. Now, obviously making your mortgage term a bit longer means you're essentially in that mortgage debt for longer, which means that compounding and interest works in the bank's favor much more than your favor. But at least it will help you be able to get by in these times. The more things get a bit more difficult as expected over the next few months. Now, speaking to savings, obviously rising rates means good news for savers. I've just gone to look at some of the easy access savings accounts, which are the sort of accounts I'd expect you to put your emergency fund and things like that into. Rates are kind of hovering at around 0.39% and so on, and either way of that number. So what I would suggest here is to consider, if you've managed to save an emergency fund 3 to 6 months of essential living expenses, if you're fortunate to have been able to do that into an easy savings account, and you have some additional savings, you might want to consider fixing your savings, getting a fixed rate deal for a bit longer. But you don't want it to be too long though, because rates are changing. We're going to expect another rate change again in August. So you might want to fix for fix for 6 months, for example, and then look out for what things look like as soon as rates have risen again in the next few months, which people expect. Now, speaking to investing, we talk about investing a lot on this channel. One thing that's very clear is essentially that we are in the UK, we've got a shrinking economy. That's really what's going on. We've got high inflation, we've got declining GDP. Okay, that points to stagflation. Okay, so one thing I would say, and the way I'm looking at this personally for my own investing purposes, is that I'm actually pointing my investing to other parts of the world. Okay, now you don't have to do that, based on what I've said, but I'm investing more in the US personally, and looking at other global focused ways for me to invest my money. Okay, that's what I'm doing. Okay, so just to wrap this up real quick, in conclusion, inflation's hitting 11% or more CPI inflation from October onwards. GDP is declining 0.3% is the expected decline in GDP compared to their forecast of 0.1% for the period from April to June of 2022. All of this points to a shrinking economy. All of this points to stagflation, which essentially means that growth is declining but inflation is rising, which is not good news for anyone. The Bank of England now have to thread carefully. They've been threading very carefully and have been criticised massively. And you could argue rightly so, because you'd expect, looking at the Fed and looking at other participants who are also in control of these rates, they are shifting their rates a lot more aggressively as a way to try to combat inflation. I would say personally, from my perspective, that I honestly see a future of high inflation rates becoming a normality. That's what I see personally. But the whole idea of trying to bring inflation rates back down to 2%, I don't know about that, but we'll see how things pan out. But yeah, other than that, keep an eye out. Markets are forecasting the interest rates, as I mentioned before, will by 2022 be at around 2.9%. 2023 will peak at around 3.3%. But again, we all know these forecasts in many ways don't actually mean very much, because at the end of the day, the numbers end up being a lot higher. So think the worst and prepare as best as you can within your households. Please stay encouraged in these times. I know things are very difficult, things are very challenging, but I thought I'd just do this quick update to share what I will be doing in these circumstances, what we're doing in these circumstances, and how you should perhaps consider thinking about your mortgages, your savings, and your investing in these times. If you've got any questions, please jump in the comments below. All right, much love.